Investing in the stock market can be a daunting prospect. Picking individual stocks can be a difficult process. The academia shows that it is difficult to do this successfully over long periods of time. Index funds, however, have proven to be a successful way of investing in the stock markets. But what exactly is an index fund, and how should you choose which index funds to invest in? In today's episode, I'm going to explain all the basic concepts that you need to know for index investing. Hello, my name is Lewis and welcome to IQ Investing, where we talk about saving, investing and everything in between. In this video, I'm going to explain what an index fund is, whilst discussing some of the key considerations about index fund investing. So, to start us off, what is an index fund? An index fund is a portfolio of stocks or bonds which is designed to mimic the composition or performance of a financial market index. The first index fund was created on December 31st, 1975 by Jack Bogle. Investing firms before then would select stocks to make up certain portfolios, whilst charging a high fee to do so. The concept of index funds is that buying all of the stocks in a market index will perform better than buying individual stocks in that index. Because this fund does not have to be actively managed, the management fees, also known as expense ratios, are inherently low. The important question is, why should you invest in index funds? So you might be thinking, how can buying and holding every single stock in a market be better than hand selecting those stocks themselves? It sounds crazy. To no surprise, Bogle was merely laughed at when he proposed the idea to the investing world. However, the truth is that it actually works. Vanguard released a study in 2013 explaining that from 1998 to 2013, 45% of actively managed funds collapsed. Also, a massive 82% of those actively managed funds failed to outperform the index. Well, now you might be thinking, why don't I just select a managed fund that outperformed the index? This leads into one of the most common pitfalls in investing. Past performance is not a good indicator of future results. What I mean by this is that just because the fund has done well in the past, this does not mean that it's going to perform well in the future. Of the 18% of funds that manage to outperform the index, what is to say that they are going to carry on to outperform the index over the next 15 years? Also, how do you know if you're choosing one of these winning actively managed funds? The moral of the story is that index funds come out as king. So now you might be thinking, what about picking your own stocks? Right, so actively managed funds can't beat the index, but I think I can. Now, don't get me wrong on this one. Everybody can pick a stock that performs well. Take me for example. I started investing because my friend told me about the Tesla stock which did not stop going up. So, there I was, clueless about investing, but what did I do? I bought some Tesla stock. Over the next few months, it grew way more than the market did. And because of that, I made a solid profit. Great. But the real question is, was this a good investment? There is only one answer to this question, and that is no. The reality is, I knew nothing about Tesla's business model at the time. I certainly didn't look at the balance sheet, and I did not forecast the company's growth. Even if I had done all of this, what's to say that my analysis of this stock would be better than that of a professional institution? Every time that you buy or sell a stock on the stock market, you need to ask yourself, who's on the other side of the trade? What does this person know about this stock that I don't? When you eventually come to saving thousands or hundreds of £1,000s to invest, are you really going to trust your own knowledge and put that much money on it? Now look, I'm not saying that you can't be successful if you choose to do this, but what I am saying is that the odds are against you, and that index funds produce the most reliable risk-adjusted returns. This brings us right on to our next question, which is, what are risk-adjusted returns? A risk-adjusted return is a calculation of the profit or potential profit from an investment, but it takes into account the degree of risk that must be taken in order to achieve it. Now risk can come in lots of shapes and sizes. In fact, I'll be posting many videos in the future which are going to be dedicated to just risk. The basics of portfolio risk that you need to know is that the more concentrated your portfolio is, the more risky it tends to be. Let's say that you hold one stock for example, like the Tesla stock I had. 100% of your investment would be dependent on the success of that one company. What if an unexpected event happened? Let's say a new source of power was invented and the electric vehicle and battery markets were destroyed. All of your invested assets, which lie in the Tesla stock, are likely to crash. Or, let's say, you hold 50 stocks that are based in the UK. But then, a meteor strike occurred and the country was destroyed. Your investments are likely to fall to zero. This is because they are all based in the same geographical location. Now, I know these examples are a little extreme, but you get the point. If the Tesla stock, or the 50 UK stocks which you held, were held within an index fund with hundreds of other stocks within that, then the damage to the portfolios after the catastrophic events would be much less significant. The key here is diversification. Generally, the more diversified your portfolio is, the higher your risk-adjusted returns will be. So next, you've decided you want to become an index fund investor. Stock picking just isn't for you. You've realised that index fund investing is more simple, less expensive, and has better risk-adjusted returns. The last thing to decide upon is which index funds should you invest in. Now, this is not an answer that I can give to you in black and white. What I can do is remind you of the importance of diversification. A popular option amongst many investors is to invest in index funds that focus just on the USA markets. You may have already heard of the S&P 500 index fund. This tracks the 500 largest companies listed on the USA stock exchanges. Or maybe you'd want to hold the entirety of the USA's markets. This means all companies, including small, medium and large. The reason that these investments have become so popular is because of how well the US markets have performed. The USA stock markets account for around 67% of the global stock markets. I just want to remind you that it wasn't always this way. In early 1989, Japan accounted for 45% of the global stock market. This was followed by the US at 33% and the UK at 9%. This can be compared to now, where Japan only makes up for 8% of the global stock markets. The USA is now at 67%, whilst the UK is now at 4%. If you only held a Japanese market index fund in the late 1980s, your portfolio would still not have recovered to this day after the stock crash that happened. What I am saying is that diversifying the index funds which you buy can reduce the risk of suffering from a bitter loss like this. And that is all you need to know on the basics of index fund investing. So in summary, index fund investing is a simple, cheap and reliably successful method of investing in the stock markets. Although it may not be as flashy or impressive as stock picking, it tends to come out on top. When you are buying an index fund, you are increasing your risk-adjusted returns by owning a broader range of the market. However, holding one index fund which concentrates on a specific market or geographical location can still be considered to suffer from poor diversification. I hope that you've learned all you need to know on the basics of index fund investing. But if you do have more questions on this topic, please drop them in the comments below. As always, a like on the video is massively appreciated, and I'm going to keep up the bi-weekly content over the next month. So please subscribe for more saving investing based content. And with that, I wish you all a great day. Thanks for watching.